So earlier this month, the founder and CEO of Twitter and Square, Jack Dorsey, announced that employees of both companies would be able to work remotely indefinitely, even after social distancing guidelines have been lifted. Other big tech giants like Facebook have followed similar paths, with Mark Zuckerberg announcing last week that up to half of Facebook's employees could be working remotely in the next 5 to 10 years. So, with most office spaces still shut down across the country, what does this mean for office real estate investors going forward, both now and in the future? That's what we'll cover in this video. Hey, this is Justin from breakintocre.com, and if you're new here, on this channel we talk about real estate investing careers and real estate financial analysis. So if you're looking to break into the industry or do your first real estate deal, make sure to subscribe and hit the notification bell to be notified every time I release a new video. So unfortunately, things are getting rough out there right now, with almost 40 million US workers filing unemployment claims since March. And although retail, hotel, and food service related job losses accounted for about 40% of that figure, almost 20% of that is still attributed directly to traditional office employment in the professional services and finance, insurance, and real estate sectors. So with significant job losses, temporary required remote working, and even potential long-term remote work planned for many corporate users, what does this mean for office space and office investors in 2020 and beyond? Well, first, let's talk about what's going on today. So last week, Owen Thomas, the CEO of major real estate investment trust that invests in office properties, Boston Properties, told CNBC that the company is collecting rent from about 95% of office tenants in their portfolio. And with over 50 million square feet under management, this is a huge sample size that spells positive news for real estate investors who currently own office properties in major metros today. But with that said, even though many office users might be willing and able to pay rent today, that doesn't necessarily mean they'll be willing to renew their existing leases when those leases expire, at least at the same footprint as they've occupied in the past. So aside from just the tech giants like Twitter, Square, and Facebook announcing more permanent work from home plans, other traditional, more blue chip companies like Nationwide Insurance and Barclays have also mentioned plans to move a significant portion of their workforce to more permanent remote roles. Other tech companies like Shopify and Coinbase have also announced plans for employees to be able to work from home permanently even after restrictions have lifted. Even the CEO of Morgan Stanley, James Gorman, was quoted in April saying that the firm could operate with much less real estate and talked about a future where employees were able to spend days, weeks, or even months working remotely outside of the office. According to a survey done last month by the research firm Gartner, 74% of CFOs surveyed plan to move at least 5% of their current workforce to more permanent remote positions, and nearly 25% of those surveyed plan to move at least 20% of their workforce to permanent remote roles. In that same survey, 22% of CFOs reported either planning to make reductions in real estate related expenses over the coming months, or they had already made real estate related cost reductions as a response to nationwide shutdowns since March. Real estate pricing and valuations are directly correlated with supply and demand in the market, and even before this crisis hit, office wasn't doing so hot from a fundamentals perspective either. National vacancy rates were 12.3% in Q1 of 2020, according to CBRE data, and new supply significantly outpaced demand in the first quarter of the year. And with some sort of a forced work from home trial run well underway for many companies across the US, and many of these companies already seeing the potential cost savings of making this a long-term strategy, office could see a significant decline in demand in the coming years, even after all of this crisis has subsided. So with that in mind, if you're an office real estate investor today, where might the opportunities and the risks lie in the space going forward? Well, the biggest risk and opportunity might actually lie in the same thing here as a result of this, and that is that we may see a slight shift away from clustering all talent in major metros and allowing more employees to work remotely wherever they may be. So just 5 cities, including San Francisco, Boston, San Diego, San Jose, and Seattle, have accounted for over 90% of the new tech jobs created from 2005 to 2017, which has driven the cost of living up significantly in these areas over the last 15 years. And as a result, employers have had to pay their employees higher and higher wages just to keep up so that those employees could afford to live in those expensive cities. But for many millennials who are now entering their 30s and starting to have children, buying a home in a city like San Francisco with median home prices over $1.4 million just isn't in the cards for even some of the most well-educated dual income households. And if you couple that with potentially a desire to be closer to family members that aren't in that same part of the country, many young educated workers would likely welcome the ability to move to an area with maybe a lower cost of living and still be able to keep their job in the process. And this thought is actually backed up by recent research. So according to a 2019 survey done by the San Francisco Comptroller's Office, over a third of respondents said they were either somewhat likely or very likely to leave the city in the near future. And this shows that many people were considering making a move before anything started to happen with this crisis in the first place. And with job losses and layoffs becoming the norm, we might see an even quicker exodus from these major metros if employees of some big companies can start working remotely from a different city. And in a scenario where employees work remotely in different parts of the country, this could also have a significant positive impact on employers. So salary expectations will be lower for talent outside of major metros, and companies will be able to attract talent that might otherwise not have wanted to uproot their entire families and move across the country to land a new job otherwise. Mark Zuckerberg has actually already talked about reducing salary costs by hiring remote workers in other less expensive parts of the country, and many other companies are likely to follow suit if they're able to find qualified talent in another area of the country and potentially pay that talent a little bit less to decrease payroll costs while still keeping those employees happy and well paid compared to what they might expect to be paid based on where they're living currently. With that said, even if remote hiring does ramp up, smaller satellite offices might also see an increased demand in smaller, more suburban outskirts in major US cities. So while the ability to work from home has been discussed in detail by many big firms, including the big tech giants, that talk has not been without lots of talk of employees actually having a place to go if and when they decide to come back into an office environment. So instead of taking away the need for office space, this could potentially just shift the footprint demand from primarily being clustered in these major cities and downtown metros that we've been seeing over the last 15 years to more suburban city outskirts and satellite offices, creating opportunities for office investors who own properties in the suburbs of major US markets. Now, with the potential shift in demand, on the other side of the coin, this could also spell trouble for office owners in downtown areas if these footprint requirements are reduced and companies begin to focus on building these satellite offices for people to be able to reduce their commute and work close to home. There is some speculation, including recent comments from the CEOs of Google and WeWork, that additional space will actually be needed due to the need for employees to remain 6 feet apart. But with the bottom line as the main priority for nearly all companies that occupy office space, it's not likely that many of these firms will be expanding their office footprint in the next several years, specifically in that downtown environment. And during this time, many companies have seen how virtual meeting and communication platforms like Zoom and Slack have made it extremely easy for knowledge workers to be able to stay in touch regardless of where they're located. And now more than ever, this could be seen as a very logical, progressive shift for many firms, especially software and technology firms that don't rely on their employees to work on manufacturing or physical products. For many employees, satellite offices or the ability to work from home is also a really big win because these employees are either able to reduce or eliminate commute time and oftentimes are able to set the majority of their schedule as far as when they want to work around other commitments that they might have. So with all of that said, it appears that office vacancies will likely increase over the next several years, office development projects will likely be put on hold indefinitely, and office rents will continue to soften, especially in major metropolitan cities and downtown areas. Now, this definitely isn't to say that all office properties are going to be failing, and strong credit tenants are likely to continue to pay rent for the foreseeable future as long as their business isn't adversely affected by the current economic crisis. But with that said, the current economic climate could and likely will also create a significant shift in leasing trends in office long term. So aside from just the potential to move to satellite offices, office leases are also commonly signed with lease terms from anywhere from 3 to 10 years or more. And with office space needs more up in the air than they have been at any time during this decade, this may change significantly as leases with expirations in 2020 and 2021 start to roll over. So with many companies unsure of how a transition to more full-time permanent remote work will turn out, short-term 1 to 2 year leases, even for large footprints, may become more of the norm for office users, as those users are likely to have a lot of negotiating leverage in the foreseeable future as well, and may be able to negotiate this with the landlord that they're working with. But overall, with all of that said, there are always opportunities in every product type in real estate, and for office, even though there is a major threat for more permanent remote work looming, this is likely going to cause a slight reduction and shift in office demand going forward, rather than the elimination of office demand completely. So for investors that can either acquire a failing office building and repurpose that, or develop or redevelop satellite offices for major companies outside of city centers where those employees live, office can present a very unique opportunity for investors over the next 12 to 24 months, as long as they're willing to adapt to those changes that we could see over the next few years. Now, if you want to learn more about how to actually analyze office properties, make sure to check out my course, The Complete Guide to Investing in Office Properties, which will walk you through the process of analyzing a potential office acquisition if you're looking to buy an office property or work in office in acquisitions or asset management this year. Also, make sure to leave a comment below and let me know where you think office is headed and any opportunities you might see for office investors going forward. So thanks so much for watching. I hope you found this helpful, and I'll see you in the next video.